There are moments in business when excitement becomes louder than reason, when ambition starts speaking over discipline, and when people stop asking the most important question of all: does this actually make sense? I've seen those moments many times over the years, and they almost always end the same way. Slowly at first, then suddenly. The story of WeWork is one of those moments. A story that began with lofty ideals, bold promises, and a charismatic founder who believed he wasn't just building a company, but changing the world. And for a while, everyone believed him. Adam Neumann didn't look like a traditional business leader. He didn't sound like one either. He spoke in big ideas, spiritual language, and grand visions about community, energy, and elevating human consciousness. He wasn't selling office space, he said. He was selling belonging. And people wanted to believe that. Investors wanted to believe that. Employees wanted to believe that. Because belief, when wrapped in confidence, can be very persuasive. And Adam had confidence in abundance. WeWork started simply enough. Rent large office buildings, redesign them into modern shared workspaces, and rent desks and offices to freelancers, startups, and growing companies. On the surface, it looked clever. Flexible leases for tenants, stylish spaces, a sense of community. And early on, it worked. Buildings filled up. Photos looked impressive. Press coverage was glowing. And Adam leaned into the spotlight. He talked about WeWork as if it were a technology company, not a real estate business. That single idea changed everything. Because tech companies get rewarded for growth, not profits. And Adam wanted growth. Fast growth. Relentless growth. Money began pouring in. Billions of dollars from investors who were afraid of missing the next big thing. The more Adam talked, the more they wrote checks. Valuation climbed higher and higher, until WeWork was being valued at nearly $47 billion. $47 billion for a company that, at its core, rented long-term office leases and subleased them short-term. There was no proprietary technology, no network effect strong enough to protect it, no clear path to profitability. But those questions were pushed aside, buried under buzzwords and belief. And Adam began spending as if the money would never stop. Private jets, lavish parties, expensive acquisitions that made little sense. He bought buildings personally and then leased them back to WeWork, charging the company rent. He trademarked the word "we" and sold it to his own company for millions. These were not decisions made with shareholders in mind. They were decisions driven by ego, entitlement, and the dangerous feeling that success itself was proof of wisdom. I've always believed that money doesn't change who you are. It reveals who you are. And as WeWork grew, Adam's behavior grew stranger. He talked about becoming the world's first trillionaire. He spoke about WeWork's mission in almost religious terms. He made impulsive choices that left seasoned executives uncomfortable, but few challenged him. When a founder is treated like a prophet, disagreement starts to feel like heresy. And so, people stayed quiet. The company expanded at a breathtaking pace. City after city, country after country. Buildings signed faster than they could be filled. Costs ballooned. Losses widened. WeWork was burning billions of dollars every year, but Adam brushed it off. Growth would fix everything, he said. Scale would bring profits later. That's a common story in Silicon Valley. Sometimes it works. Often, it doesn't. And in businesses with heavy fixed costs like real estate, it can be fatal. Behind the scenes, employees were exhausted. Leadership was chaotic. Decisions changed by the day. One moment, WeWork was acquiring schools, then wave pools, then talking about living spaces and wellness brands. Focus disappeared. Discipline vanished. The company wasn't being run like a business anymore. It was being run like a vision board fueled by other people's money. Then came the moment that forced reality into the room. WeWork decided to go public. An EPO would expose everything: the financials, the governance, the losses. And when investors finally saw inside, the illusion cracked. Billions in losses. Conflicts of interest everywhere. A CEO with near total control and behavior that raised serious concerns. The story unraveled quickly. Suddenly, the same investors who once applauded Adam's boldness began questioning his judgment. The valuation collapsed. 47 billion turned into 10, then less. Adam was forced to step down as CEO, though not before negotiating a massive exit package. Employees watched in disbelief as the man who led them into chaos walked away wealthy, while their stock options became nearly worthless. And just like that, WeWork's dream was exposed for what it really was. Not a revolution, but a cautionary tale. A reminder that no amount of storytelling can replace sound fundamentals. That growth, without discipline, is just accelerated failure. And that when leaders confuse personal ambition with corporate purpose, the damage spreads far beyond themselves. This was only the beginning of the collapse. The money, the power, the recklessness, it all had consequences that would ripple for years. And as we'll see next, the deeper you look into WeWork, the clearer it becomes that this downfall wasn't caused by one mistake, but by a pattern of them. What often gets overlooked in stories like this is how quietly the damage builds. It doesn't arrive with sirens or headlines at first. It shows up in small compromises. A rule bent here, a concern ignored there. And at WeWork, those compromises became part of the culture. As long as the company kept growing, as long as new money kept flowing in, almost anything was tolerated. That's a dangerous environment because growth can hide a lot of mistakes. And Adam Neumann, surrounded by praise and unchecked authority, began to confuse momentum with mastery. Inside the company, people started to notice that WeWork wasn't being run with discipline. Meetings felt more like sermons than strategy sessions. Decisions were driven by Adam's moods and impulses. One day he wanted aggressive expansion. The next, he wanted to pivot the entire company toward living spaces, schools, or wellness. Executives struggled to keep up. Plans changed constantly. Long-term strategy was replaced by whatever vision sounded inspiring that week. And when people raised concerns, they were often ignored, sidelined, or pushed out. Adam surrounded himself with loyalty, not challenge. That's another pattern I've seen many times. When leaders stop listening to people who disagree with them, they lose their balance. WeWork's board was packed with people who believed in Adam's charisma more than they questioned his decision. Governance became weak. Oversight became symbolic. And that allowed problems to grow unchecked. The company's finances told a troubling story, but few wanted to read it closely. WeWork signed long-term leases, often for 15 or 20 years, committing itself to massive fixed costs. But it rented that space short-term to tenants who could leave at any time. In good economic conditions, that mismatch is manageable. In bad times, it's devastating. Yet Adam pushed expansion harder than ever. More buildings, more cities, more countries. Each new lease increased the risk. Each new location added pressure. But the losses were framed as investment. The cash burn was reframed as growth. And as long as investors kept writing checks, the illusion held. Then there were Adam's personal choices, which blurred the line between founder and company in ways that should have raised alarms much earlier. He borrowed hundreds of millions of dollars against his WeWork shares for personal use. He used company money for personal projects. He treated corporate assets as extensions of himself. This wasn't just poor judgment. It was a breakdown of boundaries. And when boundaries disappear, accountability usually follows. Employees felt the consequences. Many joined WeWork believing they were part of something meaningful. They worked long hours, accepted lower pay in exchange for stock options, and trusted leadership to guide them responsibly. But as Adam's behavior grew more erratic, morale declined. People whispered concerns in hallways. They questioned the company's direction. They worried about sustainability. Still, the public image remained glossy. Inside, cracks were spreading. The real turning point came with the IPO filing. That document, meant to attract public investors, did something unexpected. It revealed the truth. Not just the numbers, but the governance failures, the conflicts of interest, and the scale of the losses. Analysts and investors reacted with shock. How could a company losing billions every year be valued so highly? How could a founder with so much control behave with so little restraint? The questions came fast. And this time, Adam couldn't talk his way out of them. Confidence evaporated almost overnight. The valuation dropped dramatically. Potential investors walked away. The IPO was pulled. And suddenly, WeWork was facing a reality it had long avoided. Without constant injections of capital, the business couldn't survive as it was structured. The growth at all costs strategy collapsed under its own weight. SoftBank, WeWork's largest backer, stepped in to prevent total disaster. But the rescue came with conditions. Adam had to step aside. Control was stripped away. The very people who once celebrated his vision now worked to limit his influence. For Adam, it must have felt like betrayal. For the company, it was a necessary correction. But the damage had already been done. Layoffs followed. Thousands of employees lost their jobs. Projects were canceled. Expansion stopped. The dream that had been sold so passionately was quietly dismantled. Buildings that once symbolized ambition became reminders of excess. And the culture that once promised community now struggled with uncertainty and disappointment. What struck me most about WeWork's unraveling wasn't just the scale of the losses. It was how predictable it all was. When a company prioritizes image over substance, growth over governance, and charisma over competence, the ending rarely surprises those who've seen it before. It's a slow-motion collapse, disguised as innovation until reality intervenes. Adam Neumann walked away with a fortune, even after being removed. That fact angered many people, and understandably so. But focusing only on him misses the larger lesson. This wasn't just a failure of one man. It was a failure of checks and balances. A failure of investors to demand discipline. A failure of boards to enforce accountability. And a failure of a culture that celebrated boldness without asking whether it was backed by wisdom. The story of WeWork isn't finished yet. The company survived in a smaller, humbler form. But the myth is gone. And what remains is a powerful reminder. Businesses don't fail because they dream too big. They fail because they forget the basics. Profit matters. Structure matters. Integrity matters. And no vision, no matter how inspiring, can replace those foundations. In the next part, we'll look at the final unraveling, how the dream finally collapsed under scrutiny, and what this story teaches anyone who believes that confidence alone is enough to build something lasting. When the momentum finally slowed, the silence was deafening. For years, WeWork had lived in a world of constant motion. New leases, new cities, new announcements, new funding rounds. Movement itself became a kind of distraction. As long as something new was happening, no one had to sit still long enough to ask whether it all added up. But after the EPO failed, that movement stopped. And in the quiet that followed, reality became impossible to ignore. The company was losing billions of dollars a year. Not because of a temporary investment phase, but because the core business simply didn't generate enough cash to support its obligation. WeWork's model required signing long-term leases at fixed costs, while depending on short-term customers whose loyalty could vanish overnight. In a booming economy, that risk could be hidden. But in any downturn, it would become a liability. This wasn't a software platform that could scale with little marginal cost. It was real estate, heavy, expensive, and unforgiving. As new leadership stepped in, they began the difficult process of unwinding years of unchecked expansion. Buildings were closed. Leases were renegotiated or abandoned at great cost. Entire projects were scrapped. Each decision felt like admitting a mistake that should have been obvious earlier. But admitting mistakes is rarely easy, especially when billions of dollars and thousands of livelihoods are involved. For Adam Neumann, watching this from the sidelines must have been a strange experience. For years, his identity had been inseparable from WeWork. He wasn't just the CEO. He was the symbol, the storyteller, the face of the dream. And now that dream was being dismantled piece by piece without him. The very company he once controlled was moving on in a quieter, more restrained way, one that no longer needed grand speeches or spiritual language to justify itself. There's a particular kind of pain that comes when confidence meets consequence. It's not loud or dramatic. It's internal. It's the slow realization that belief alone isn't enough, that charisma doesn't replace structure, and that optimism doesn't cancel out math. I imagine Adam had plenty of time to reflect on that, because once the spotlight fades, you're left alone with your decisions. The public reaction was unforgiving. WeWork became a symbol of excess, a cautionary tale repeated in business schools, boardrooms, and headlines. Adam's name became shorthand for founder overreach. And while it's easy to assign blame to one individual, the truth is more complicated. Many people enabled this outcome. Investors rewarded growth without asking for profits. Boards failed to enforce discipline. Advisors stayed silent when they should have spoken up. And employees, though often powerless, were swept along by a culture that discouraged skepticism. Still, leadership carries responsibility, and Adam's leadership style played a central role in WeWork's collapse. He believed deeply in his own narrative. He trusted his instincts more than data. He saw caution as weakness and restraint as a lack of faith. Those traits can be inspiring in small doses. In excess, they become dangerous, especially when paired with unlimited capital. One of the hardest lessons in business is understanding that not every company is meant to be a revolution. Some businesses succeed by doing simple things well, consistently, and responsibly. WeWork could have been one of those companies. With disciplined growth, realistic valuations, and strong governance, it might have built a sustainable niche. Instead, it tried to become everything at once: a tech giant, a lifestyle brand, a global movement. And in trying to be everything, it lost sight of what it actually was. The fallout didn't stop with WeWork itself. The collapse forced investors to rethink how they evaluate startups. It sparked conversations about founder control, voting rights, and accountability. It raised questions about how much power should be concentrated in one person's hands. In that sense, WeWork's failure became a lesson for the entire market. A painful one, but a necessary one. For employees, the consequences were deeply personal. Many had built their lives around the promise of WeWork. They believed in the mission. They trusted leadership. And when the company shrank, they paid the price. Jobs were lost. Careers were disrupted. Dreams were deferred. These are the costs that rarely make headlines but linger long after the story fades from public attention. What stays with me most about this story is how ordinary the warning signs were. Overspending, lack of focus, conflicts of interest, weak governance. These aren't rare or mysterious problems. They show up again and again in corporate failures. And yet, when success is loud enough, those signals are often ignored. People convince themselves that this time is different, that the rules have changed, that the old lessons no longer apply. They always do. WeWork's collapse wasn't sudden. It was the result of years of decisions that prioritized speed over stability and vision over verification. And while the ending felt dramatic, The path leading there was paved with choices that could have been corrected early on. That's the tragedy of it. Most disasters aren't inevitable. They're allowed to happen. In the final part, we'll step back and reflect on what this story truly teaches. Not just about Adam Neumann or WeWork, but about leadership, humility, and the quiet discipline required to build something that lasts. When enough time has passed, every business story becomes less about numbers and more about character. Balance sheets fade, valuations get revised, and markets move on. What remains are the lessons. Quiet, uncomfortable truths that don't announce themselves loudly, but stay with you if you're willing to listen. The collapse of WeWork, at its core, is one of those lessons. It's a reminder that leadership is not about vision alone. It's about restraint, responsibility, and the willingness to accept limits. Adam Neumann never lacked belief. He believed in himself, in his ideas, and in his ability to bend reality through confidence. And belief, when paired with humility, can be powerful. But belief without discipline becomes arrogance. It creates an environment where questions feel unwelcome and caution feels like doubt. Over time, that mindset distorts judgment. You stop seeing risk as something to manage and start seeing it as something to outrun. One of the quiet tragedies of WeWork is that its core idea wasn't inherently flawed. Flexible office space filled a real need. Community mattered to people, especially in an increasingly isolated world. With thoughtful execution and realistic expectations, the company could have grown steadily, profitably, and sustainably. Instead, it chased scale before stability. It treated valuation as validation, and in doing so, it lost control of its own narrative. There's an old saying in business that I've found to be consistently true. You don't find out who a company really is during good times. Anyone can look smart when money is cheap and markets are rising. True leadership shows itself when capital tightens, when growth slows, and when difficult decisions have to be made. In that moment, clarity matters more than charisma. Structure matters more than storytelling. And WeWork, built on momentum rather than fundamentals, struggled to survive that test. For investors, the WeWork story offers a humbling reminder. Due diligence isn't optional, no matter how exciting the pitch. Governance isn't a formality, no matter how talented the founder. And profits, sooner or later, matter. Growth can buy you time, but it can't buy you immunity from reality. When investors forget that, they become part of the problem, not just observers of it. For founders, the lesson cuts even deeper. Control is a responsibility, not a reward. Influence should invite accountability, not eliminate it. And surrounding yourself only with people who agree with you is one of the fastest ways to lose perspective. The strongest leaders I've known weren't the loudest or the most confident. They were the ones who listened, who asked uncomfortable questions, and who knew when to slow down. WeWork survived, technically. It restructured. It downsized. It adapted. But survival isn't the same as success. The original dream, the one fueled by grand promises and boundless ambition, is gone. What remains is a more ordinary company, doing a more ordinary job, under far tighter control. And in a way, that's appropriate. Because most lasting businesses aren't built on spectacle. They're built on consistency. As for Adam Neumann, history will likely remember him as a symbol, not of innovation, but of excess. A reminder of what happens when confidence goes unchecked and power goes unbalanced. That's a heavy legacy. And while he walked away with personal wealth, the cost was far greater than money. Reputation, trust, and credibility are far harder to rebuild than fortunes. What I find most striking is how familiar this pattern feels. We've seen it before, and we'll see it again. New technologies, new founders, new buzzwords, but the same human tendencies underneath. The desire to grow faster than wisdom allows. The temptation to believe you're the exception. The reluctance to slow down when slowing down is exactly what's needed. In the end, WeWork's story isn't really about office space. It's about balance, about knowing when ambition needs to be tempered by discipline, about understanding that leadership isn't measured by how big something becomes, but by how well it's built, and about remembering that the quiet work of sustainability often matters more than the loud pursuit of scale. If there's one thought worth holding on to, it's this: success that lasts is rarely dramatic. It's patient. It's boring. It's built day by day, decision by decision, with respect for limits and awareness of risk. And when those principles are ignored, even the most exciting ideas can unravel faster than anyone expects. That's the lasting lesson of WeWork. Not that dreaming big is wrong, but that dreaming without discipline carries a cost. And sooner or later, that cost always comes